I'm the director of the Department of Insurance here in South Carolina. And welcome to this hearing. It's a public hearing on Continental Casualty's pending rate increase for long-term care insurance products here in South Carolina. Appreciate each one of you coming today. One of the biggest issues facing the insurance industry, facing regulators and consumers, is long-term care insurance. The impact felt by consumers around the nation and here at home is astounding. The most common issue that I discuss with our consumers when they call is long-term care insurance. I get calls from frustrated consumers that can no longer afford the coverage. When consumers my age bought the product 20, 30 years ago, for whatever reason, we thought that our premiums would never go up. Whether we were told that or we just believed that. Obviously, that's not the case. But as a result, this has been one of my top issues since I've been here at the department. It is also an issue nationwide with the National Association of Insurance Commissioners. This is probably the top issue countrywide, and we're almost in a crisis. So in order to raise the visibility on the issue, in July of 2018, we held a public hearing on the subject. We had companies come in that impacted consumers, a lot of whom I've spoken with before. And so companies had the opportunity to answer questions from consumers as to why their rates were going up. And we posted that recording on our website. It's about a 3-hour long hearing, and remarkably, we've had over 200 people look at it since that time. A year or so ago, I inquired the staff, why don't we hold a hearing on the rate filings, and they promptly pointed out that we didn't have that authority. Well, earlier this legislative session, we asked the legislature to give us that authority, and they did. So this is our first hearing ever under this new statute. So we are here today to discuss the requested rate increase for Continental Casualty on 2 closed blocks of business that were issued to our citizens of South Carolina between 1993 and 2004. So after our assistant actuary reviewed the filings and our internal actuary reviewed the filings, we contracted out with a team of independent actuaries to take a look at it. So this morning, first we're going to hear from Dave Dillon of Lewis & Ellis, who is the lead external actuary on the team that's been reviewing these rate filings for us. After Dave gives us an overview and his team's concerns, we'll hear from interested parties representing consumers about how these rate increases will impact our citizens. And then we'll obviously give the company a chance to respond to those questions and present their own information. So obviously this process is new to us, but we appreciate your participation, everybody's participation. So as I just said, the process will be, we'll hear from Dave Dillon, we'll hear from our consumers, and then we'll hear from the companies. And the Consumer Advocate Office is here, Carrie Linebarker and Becky Dover. They are like others. If you have a question, we'll entertain those questions at the proper time. So why don't we get started? Dave, appreciate you coming. Why don't you come around and make your presentation. Just for the record, we do have a court reporter, so speak clearly, and he'll let us know if he has any issues. And just for our own training purposes, we're having it recorded just for department purposes, and it'll probably be posted on the website at some point.
Well, Director, thank you. I appreciate it. Thanks for having me. I've already been told I unintentionally being divisive today wearing my orange, sorry. I am an Oklahoma State Cowboy, so I have a lot of orange, so I didn't even think about that today. So no intentions here coming into Columbia wearing my orange. But the Director is correct. This is a very hot button issue, long-term care. I have been asked a lot lately about long-term care. Just a few weeks ago, I was asked to testify in front of the Kentucky legislature because of all the complaints they get from seniors, and so this is a very important issue and very on top of mind of a lot of people. So just a little background on me and my firm and what we do with rate filings. So, as Director said, I'm with Lewis & Ellis. I've been there 20 years. Since 2010, we've assisted 22 states with rate filings. We're currently assisting 14 states with rate filings, including long-term care. So we see a lot of long-term care rate filings from a lot of different companies. We see a lot of the issues. So regarding these specific rate requests, there are kind of two blocks here. Kind of what we'll say the R16 is the preferred solutions. This specific request is over 100%. As Director said, these were sold up through 2003. This specific request is for the policies that have an inflation rider. Okay, so the benefit increases for the policyholders. There's a little over 500 policyholders impacted. Then we have the R17 block, which is comprised of 3 smaller blocks. And the average increase is between 15 to 20% depending on the block question. And there's about 300 South Carolina policyholders here. So what is the rate review process? What do we do? Director mentioned that the South Carolina staff look through it, and their process is the same thing we utilize. There's really kind of 2 overriding principles or guidelines that we have to review or kind of follow, and that's actuarial standards of practice and the state law. Now, there are a lot of the same overriding principles in those 2 documents, but they don't always correlate. There's a lot of differences. As I review some of those states, there are differences in South Carolina versus other states, but there are some similarities. So I'll start with actuarial standards of practice. So now the company has to follow this as well. So when they file the rate increase, they've got to follow this guidance, and we have to follow it as we review it. And there's other actuarial standards of practice as well that the company and as the reviewer we've got to follow. And I've just picked out a couple of the key sections of ASOP 8, which are 311 and 312, which talk about the regulatory benchmark and the reasonableness of assumptions. And so these are really kind of the key definitions, the key things we look at in the filing. We look at the adequacy of the rates, okay? Do they cover everything they need to cover? Are they excessive or not? Okay. Is the company charging too much or not? And then rates not unfairly discriminatory. That gets to basically if you have 2 people that are kind of similarly situated, are they getting kind of charged the same amount, right? You don't want to charge somebody that's basically the same demographics or live in the same general area. Make sure they're getting charged the same amount. And then the projected loss ratios. I haven't gotten into too much of the detail here, but long-term care has had different loss ratio standards over the years, and depending on when a policy is issued, there have been different standards. But that goes to this. So when a policy is issued, the company does have different loss ratio standards they have to comply with. So section 312 is the reasonableness of assumptions. Just pulled out one section here that the assumption should be reasonable in the aggregate and for each assumption individually. Now moving to the South Carolina code of laws. So when you read the actuarial code of conduct and actuarial standards of practice, it is very clear that it says, as an actuary, you got to follow the ASOPs, but the state law overrules everything, okay? Now, as I said earlier, the state law doesn't always, a state's law doesn't always line up perfectly with the actuarial standards of practice. There are some differences, but you will see here that the first part of the South Carolina Code of Law lines up pretty well with the actuarial standards of practice here. The first set of the standard of the review for the director in terms of disapproving or modifying the rates, you'll see here that the first 4 criteria line up very well with what I showed earlier in terms of the regulatory benchmark. The director can disapprove or modify the rates based on those 4 criteria I mentioned earlier, and then 2 of the criteria are related to the reasonableness of the assumptions in terms of the aggregate or based on assumptions that are not reasonable individually. So those line up very well with the ASOP. Now, South Carolina law, like every state, has some nuances that are a little bit different. And so the director also has some additional factors for consideration in disapproving or modifying the rates. And these are those. And so again, these are specific for South Carolina. And so the director has these to take into consideration. Past and prospective loss experience in and outside of the state, a little different nuance compared to some of the other state laws. Past and prospective expenses, countrywide and specifically to the state. So I point those out because that is a little bit different for South Carolina than some of the other states, take into consideration what's going on outside of the state, prior approved rate changes, and the bottom one, any other relevant factors. That's a little bit different than some other states as well. Okay, so I'm going to get into some of the specific filing observations that my team, I will back up, I guess, a little bit. So the director mentioned that his internal staff looked at this, and then my team coordinated with the South Carolina team. And what we did is, how we do it, I want to briefly describe how my team coordinated with the South Carolina staff. So what we do, we have 3 credentialed actuaries on the Lewis and Ellis staff that are assigned in some capacity to each filing. So Kevin Ruggeberg is a credentialed actuary that was a lead actuary for these specific filings. So he was the one that did the bulk of the review and coordinated with the South Carolina staff to recommend questions for additional, to be submitted to the company and things like that. And then Brian Stentz was a peer reviewer. Brian is the lead reviewer on other filings here in South Carolina. So Brian was set as a peer reviewer because he's familiar with other filings in the state, knows what the other issues are that other companies have faced. And then I'm a secondary peer reviewer to make sure there's consistency across filings. And as I said earlier, I assist other states with other long-term care filings. So I make sure that issues that other states have seen are addressed here as well. So because based on having 3 reviewers, we want to make sure that we hope to have all of the issues addressed in the questions. Okay, so to the specific filing observations. So this is the R16, the preferred solutions. This is the one with based on the inflationary rider, about 500 policies. The most recent approved rate increase was 20%. But to date, not counting this proposed increase, there has been a cumulative rate increase of over 100%. If this rate increase is approved as proposed, the rates would be approximately 4.75 times the original rates. The company stated in their filings that they waited to begin the rate increase process until the block was 100% credible. The company applied a current discount interest rate to calendar years more than 10 to 20 years past. Only a 10% increase would be needed for South Carolina rates to meet the nationwide average of all the approved increases. And approving the requested increase would put the South Carolina premiums at approximately double the nationwide average. One thing I do want to point out, and this kind of goes back to Director Farmer's original comments, is there is no question that long-term care, just in general, the policies need increases, right? We're not disagreeing with that. You know, the department has approved increases. You know, as we've said, they've already approved over 100%. We're not disagreeing with that. But these are observations in terms of what we have seen in this filing. And then on the other filing, the smaller filing, the most recent approved rate increase was 20% in February of 2018. The cumulative rate increase so far is between 130 to 150%. If the rate increase is approved, it'd be about 3 times the original rates. Again, the same comments as the other filing regarding the 100% credible. That just goes to the kind of the size of the block. When did they see that the block was beginning to deteriorate, and when they began to take rate action? And then the same issue with the interest rate. And that is the end of my prepared remarks, Director.
Good, thank you, Dave. I've got a couple of questions.
Sure.
And then we'll see if anybody else does, and we'll limit the questions here, so just for the flow of the hearing, but we may come back for other questions. You mentioned CNA's approach was to wait until the block was 100% credible. I'm not so sure I understand what that means, and then is that normal for?
Yeah, so statistically credible or credible, it's basically, you have a hint, you see something's going wrong, do you believe it or not, right? So they sold these policies in 1993, 1994, you know, the loss ratios are bad, the experience is bad, but they've only sold a few policies, right? Do you believe it or not? Was it just a blip on the radar? Will it start turning around? You know, you know, think of it as like flipping a coin, right? You flip a coin 3 times in a row, you get heads, heads, heads. Well, we all know it's going to come back around. Well, we don't know about that with long-term care insurance, right? So they wait, and you get more experience, you sell more policies. Well, when you get about 50% credible, you sell more and more policies. It is typical for companies to start raising rates when they realize that it's probably not going to turn around. And so what that does, Director, is they could raise rates maybe 10%, you know, initially. Lapses. So lapses is one of the key assumptions that was wrong when long-term care policies were initially priced. Most people price policies to think that there would be about 5% lapse each year. Out of every 100 policies sold, about 5 people would lapse. Well, it turned out about 1 person lapsed. So there were a lot more people sticking around to spend claims. And so that was a lot of what happened here. And so there was some experience that there were some observations that they had more people sticking around. And so, it is more typical to see when we review long-term care filings, as I mentioned in the observations, that it was about 10 years on the preferred solutions that they waited to file the rate increase. Typically, we would see it earlier than that.
So the lapse rate, I certainly understand. They expected 5% or more, but when we buy that policy, we bought it for a reason, and so we're holding on to it. And the 1% is the number that I've heard. So not only for this company, but obviously we've got other companies that are making rate filings, and the line is pretty long right now. How in the world, if you've got a product that has a cap on it, for the most part it has, I know some of them have an inflation rider, but most of you've got a cap. How in the world did the actuaries miss this so far? I mean, they've had, you know, that's their business. How in the world did they miss it so far that we're getting these 100% increases?
So I'm young enough that thankfully I don't have any blood on my hands.
Right.
This was in 70s and 80s is when this policy was started. Basically, it basically boils down to when you start a new policy, how do you develop something that you don't have experience on? No one knew, this had never been issued before. And actuaries, unfortunately, we thought this was most similar to an annuity policy, okay? And so that 4 to 5% I mentioned was what the lapse rates were on annuities. Annuities have been sold forever. And so as we developed these long-term care policies, we thought that's gonna be like an annuity, okay? And so that's what we based our lapse assumptions on. And unfortunately, we were wrong. And unfortunately, what happened too is there weren't a whole lot of policies sold. And there were, and I'm not necessarily speaking to this company, but across the industry, since there weren't a whole lot of policies sold, people were going, I hope it's gonna turn, I hope it's gonna turn. As I said, maybe it's just 3 flips of the coin. Once we flip the coin more often, maybe the lapses will come around, but it did not. And so then once 20 years down the road and there was enough experience to analyze, it was obviously too late. So these filings are applicable to that one of the older sets of blocks of business that was where the experience was not known. So as I mentioned earlier, there have been several modifications at the NAIC level and at the state level in trying to address these issues. I mentioned change in loss ratios. There was a thing called rate stability, which helped address some of it. There's new law. There's changes now being discussed at the NAIC, for kind of generation 3.0. So they are trying, but unfortunately, this older block, it's a little past its prime, and there's not a whole lot to be done about it.
Okay. Harry or Becky, do y'all have a question? Dave, if you have one, ask one, and then we'll get on to our consumers.
I think one of the initial ones I had, just not looking at the filing, was what are consumers currently paying and what would that jump to if the rate request was approved?
I don't know if I know the actual, off the top of my head, the dollar amount of the filing. I don't know.
But the filing was for 126%.
Yeah. In terms of dollar amount, I don't know. Anna Marie is in the back. I'm looking at her. She may have it.
What I have here is the average it's the annual, the estimated annual premium. So right now it's like 2,400, and it would be 3,370.
A big jump.
Thank you, Anna Marie.
So, Dave, you talked a little bit about how the company's applying the current interest rates to cash flow. How about going in a little detail, whether that's appropriate?
Yeah, so again, with such a long-term policy, and obviously it's in its name, right? A key assumption, in addition to the lapse rate, is the investment rate, the discount rate. What is the company? Obviously, a lot of the people that purchase these policies, well, let's say we're in their 50s, and the company is going to take those premiums, invest that, and they're going to have an assumed earned rate on those dollars that they're going to invest over those 20 years until they need to pay that out in terms of benefits for their consumers. And obviously, over the last 20 to 25 years, the markets have gone up, bond rates have gone up. There's been a lot of variation there. So that is very tricky. But so what the company has done and what we have noted is, we do allow some simplifying assumptions, right? We don't go back. We don't require that the company has to go back. Well, we earned 4.25% in this year and 3.76 in this year. But, and it is common practice to use an average. However, they have used a current rate and they've extrapolated the current rate they're earning back for all the last, let's say I'm going to simplistically say the last 20 years. But what that does is it oversimplifies and kind of ignores the profits or the earnings they made in some of those years in the past where they had higher than that. So it understates some of the money they made. So, because in a long-term care policy, the company really only has two ways to cover, to get money from premiums and from the investments. So if they use an interest rate that's a little bit lower or understates, then that means it overstates the premium or the rate increase needed. And so that's why we highlight that.
Okay. All right. Thank you, Dave. You can have a seat. We're gonna hear from our consumers at this point in the hearing. So, Teresa Arnold with AARP is here, and I know she's on a tight schedule. So, Teresa, would you come around and let us have your thoughts, and then we'll move on to other consumers.
Well, good morning. I'm Teresa Arnold. I'm the state director for AARP. We have about 615,000 members in South Carolina. It's about 32% of everybody 50 and older. So we do a lot of work in terms of protecting consumers, and one of our big partners is Consumer Affairs and Department of Insurance. So thank y'all. One thing I did want to say before I even get into my remarks is that I have always admired folks who are consumers, who listen to financial advisors, who go out and purchase long-term care insurance, because they were doing exactly what everyone said was the best thing to do to protect yourself from long-term care costs so that you could have long-term care when you get older. And part of the information that people were using is that by 2020, this is according to 2013 AARP research report, 12 million older Americans will need long-term care. Most people will be cared for at home. Family and friends are the sole caregivers for 70% of the elderly. A study by the U.S. Department of Health and Human Services says that people who reach age 65 will likely have a 40% chance of entering a nursing home. About 10% of the people who enter a nursing home will stay there for 5 years or more. And in South Carolina, 9% of people, 65%, have a self-care disability, and 11% have a cognitive disability. So the purchase of long-term care at one point in your life, especially if you were younger, was a very smart, astute financial decision. You have no control over the market forces and the potentially differential assumptions that long-term care insurance companies made at one time that didn't really predict the future as well as they could. But who could have predicted 2008? So anyway, we do have recommendations. I won't go into all of them. I'm going to leave them here for you all. But because a lot of the recommendations we have are on the front end on how to protect people from getting into policies that wouldn't be the right policies. But we also say state government, and we saw some of what our law provides for, which looks really pretty strong. State government should monitor the marketplace, ensure adherence to regulatory standards by insurers and agents, and vigorously enforce these standards, including through monetary penalties should infractions or abuses occur. I applaud the Department of Insurance because of the fact that we've gotten the law changed so we can have a hearing like this and bring these issues out. Federal and state governments should require that insurers permit reductions in the amount, type, and duration of benefits for a reduced premium to people who can no longer afford the full premium. So there should be some flexibility for the policyholder. Strong standards for premium rate increases should be established by state regulation. Policyholders should be insured a non-forfeiture benefit if their premiums increase beyond a certain level, and states should ensure the solvency of insurance companies that offer long-term care policies by establishing appropriate reserve requirements. So I really just wanted to be here briefly to let you know that AARP stands behind our members. We want to make sure they're protected under the law, but and we want to assure everyone that when you bought a long-term care policy, you did the right thing at the time. And I hate that we are going through this at this time. And I'm really looking forward to hearing Carrie's presentation as well. I have copies.
Sure. If you would let us have that, and we'll have that entered into the record, and we'll just set those on that little table behind you.
All right. Thank you. It's up to your questions.
Anybody have? Well, I will tell you, those things, those options that you mentioned about the non-forfeiture value and reduction in coverage, those are options that now companies offer. I mean, we've kind of brought pressure over the last number of years. Those are options, but as you probably noted, those aren't good options. We paid for something and now we're getting reduced coverage. But I mean, those are options if you want to stay in, keep the coverage that you've got, or take an amount that you've paid in. You'll at least have that when it triggers. And those are options, but at this point in the process, I don't see any good options.
And the worst thing, and our members and volunteers have contacted me, the worst thing is to pay and pay more and pay more and pay more, and then realize I can't pay another penny. I'm on a reduced income, fixed income, I can't pay another penny. And now I'm gonna lose everything of that benefit.
And
So-
now you have just a little bit of a safety net, but those are heart-wrenching
Correct.
decisions
That's
that
right.
people have to make, and I get those calls, and we usually, when I return those calls, we usually set aside an hour, so we can go through every question that they have, and whatever decision they make, my concern is make sure that it's an informed economic decision, and that the consumer can decide what's best for them. We appreciate you being here, though. Thank you. All right, we have a couple of consumers that are here. We'll first hear from Mr. Middleton. Mr. Marion Middleton has graciously come. Mr. Middleton, I understand, are you a school teacher?
Yes, sir.
Did you take the day off to come
I
here
did,
today?
took the day off. And I just want to say it's wonderful to have all these people paying attention to what I'm saying.
As a teacher,
It's a teacher experience, really, for me.
well, we certainly appreciate you taking time off to come be with us today. So we'd like to hear from you now.
Well, thank you. My experience is a caregiver using long-term insurance. And I just want to tell you about my background. It's my 30th year in education. I'm retiring at the end of this year, so I can go to work, make some money for my retirement. I have a bachelor's in history from the Citadel. I've got an MA from Furman. I've got 30 graduate hours over that. And when I got involved with long-term care, my father bought this policy in '98. And he kept telling me, we got it taken care of, we got long-term care, we got it taken care of. And, okay, because demographically, I'm the last of the baby boomers and the first of what we call the sandwich generation. I'm raising children and taking care of my parents at the same time. And so in preparation to take care of my parents, we built sort of a mini house beside my house, connected it with a deck so they could move in there. I could walk across the deck and take care of them. I have a sister. She was not really financially able to contribute to this. And so as my parents begin to age, they're very reluctant to give up control, surprisingly. And I've already apologized to my children. So as it got here, it was a very traumatic experience. And I know we won't talk about a lot of numbers, but let me put you in the shoes of a caregiver depending on long-term care. I'm a child, becoming a parent to the parents of the child. You see what upside down situation that is. And so now I'm going in their life, and I'm getting involved in the most intimate details of their life after all this happened. Things they did not want me to. It's nothing really bad, but you just don't want your children to see everything. But now I'm in there, and I'm scared to death because I promised my parents I would not put them in a nursing home, and I kept that promise. It was tough. And so in 2014, they got the letter, the rate increase. They bought this policy in '98, so now it's 2014. The rate increase would put it $441 a month for my mother and something similar to that to my father. They're on fixed income. There's no way you can go out and generate more income to do that. So I notified CNA, and they sent a letter. And the reason I tell you about my educational background is I had no clue what the letter said. I mean, it spelled it out, but I did not really understand it. Because the unique thing about long-term care, the person who buys this policy is probably not the one that's going to put it in execution. I was not there when this happened. I had no clue what it was all about. And now all of a sudden, here are your parents, here's the policy, good luck. And so we talked about it, and I told my mother, I said, well, what are we going to do? You got some savings. And by the way, my father had dementia, my mother was headed there. We had to have 24-hour care, it was $13,500 a month. Just for sitters, not skilled care, but for sitters. I'm a school teacher. That's 2 or 3 years salary for a school teacher. And so she said, well, we can't afford to pay it. I said, well, what are we gonna do? So if we pay it, then we'll raise it again anyway. So here's the choice, you sacrifice now and pay everything you have or later. And so we gave it up, and I filed with the commission at that point because I really didn't understand. And Ms. Rivers was so nice, she helped me understand this thing and got me some help. And I finally understood what it was. I wasn't happy with it. And maybe I would have made a different decision had I been involved in the beginning, but this is what we had. The second complaint I filed is that CNA required all this paperwork. Now, I had to hire a skilled sitter service, which was twice as much as if I could have hired just a regular sitter and really stretched out the care they gave my parents, but I had to have a skilled sitter. And they did have cash value when they canceled the policy, and I'm very grateful for that. But there was all kind of confusion about the payments, the paperwork, what's not right. I had to pull my money into it, I had to pull out my parents' money into it, and finally they did pay it up. The cash value on this policy ran out when my father died. He died in October of 2017. And his cash value he built up actually ran out almost the very week that he died. My mother lived another year. Her money, cash value ran out completely. We had to cut way back on the people that were there. She eventually, when no one was there, fell and her hip, fell out of the bed, broke her hip. And ended up, she did also have breast cancer, was another complication, and we put her in hospice, which hospice was actually cheaper than sitters. Thank God hospice was out. I did not know what I would have done with hospice. So, I know you hear a lot of numbers, but there's a human element to this thing. That I'm the child having to take care of the parents, and I'm depending on policies, and my father's told me this. Bless his heart, he did absolutely what he thought was the best thing to do. This is what they were told to do. You get this nursing care, your kid, you don't want to be a burden on your kid, and he didn't. And he was not a burden, but I took care of it. But the money just ran out, and it wasn't what we thought it was. And I hope I haven't rambled on too much, I'm sorry.
Mr. Milton, I cannot tell you how much we appreciate your testimony today. You have articulated right down to the letter of the calls that I hear from a different perspective. Usually I hear it from the policyholder, somebody my age, and they're at their wit's end. You brought a new perspective to it that a lot of us don't think about. I mean, as you said, you're the one that's got to execute the care, execute the policy, and take care of your parents. Obviously, great admiration. I appreciate what you've done.
Thank you.
Thank you for coming.
Thank you.
Yes, sir. And we have another consumer, Mr. Drinkard, is here and with us today. Mr. Drinkard, would you like to come around and let us have your thoughts?
I appreciate this opportunity to come in and speak about this subject because I am a parent that's trying to make sure that my children do not have to take care of me or my wife. And looking at this policy that we purchased, each of us, it has turned out to be a disaster for us. Small disaster, I got to admit, because it's not that I'm hurting for money, but I am hurting for the other customers as well as myself that are being affected by this. And I applaud AARP for what they're doing and asking for, and I am a member of AARP. But as I look at what we're receiving now, in 2013, our rates went up. Continental Casualty asked for an 80% increase. They got 20%. Now, at that time, I wrote a letter to South Carolina Insurance Department and received a reply back that I was just so thrilled over, I don't even know where I put that thing. But
I have an idea.
money invested in it. I paid the 20%. As the actuary stated, it's jumped up now. It's over double what it was. Last year, I said, this is insane. I'm not gonna pay that. I'm gonna drop the escalation in on the policy, which dropped it down. And speaking with the representative on the phone from the insurance company, I was under the impression that it was going to stay about there. That's not what I got this year, but it's gonna increase again. Now, I was in the freight business for a number of years. We signed contracts with customers all the time, rather large carrier that I've worked for. It's not long-term, but these contracts are fulfilled whether or not we lose money or gain money. And we're not real intelligent people. We're truck drivers, we're mechanics, some management people, and I've been in all those levels. But we have to live up to our obligations. It appears that the insurance industry can say, okay, I do not have to live up to anything that I said. The actuary mentioned that they expected a 5% drop in base, and it only turned out 1%. Okay, here we are 20 years later. I was 60 then, I'm 77 now, so that's 17 years later. There's more likelihood that I'm gonna fall over here dead than I'm gonna go into a nursing home because of my age. Now, at 60, I could have went in a nursing home. Now I may go in for a short period of time, but more than likely, I'm gonna just drop over and somebody's gonna kick me to the curb. They're not gonna pay a dime on that. My point is that 1% dropout at the time it was taken out has increased greatly now. That's not what I heard being discussed. I feel like the insurance company is doing everything they can to force people out, and I have been forced out of that escalation clause. Doing everything they can to force people out while making sure that they don't lose a dime on a bad investment by the customers. If you notice, this is the book that I received. It says CNA, doesn't mention Continental Casualty, which is a subsidiary of CNA. If you did your homework at the time that you took this out, you looked up CNA, very, very profitable company. In fact, if you look on the internet and look at their home office, they just built one that is tremendous. They're worth $42 billion according to last year's records. The loss to them through Continental Casualty is going to be very insignificant if this is really a bad deal for them. We don't know that. They're asking for 126%. Totally absurd. It makes it 4 times what it was when we bought it. So with that, I'm asking Director Farmer and his group to do not allow this kind of stuff. Look at the others where they're asking 18%, 18.6% increase on the other policies like myself that have canceled the escalation clause. This is also absurd. Cost of living didn't go up. In South Carolina, we have an average age of 77 years of age. The rest of the country is 79, somewhere in that neighborhood. Alabama being the lowest. Pretty sure it's Alabama. But anyway, take into consideration, how much longer do we have to live? I don't have any time on their estimates. So I'm not gonna be in a rest home very long on their estimates. Why did we have to pay this kind of rates for? I appreciate that.
Yes, sir, certainly appreciate you being there. You raised a crucial point that I've been looking at for a while. So you took an option to get out of the escalation clause.
That's right.
And for a short period of time, your rate stayed flat.
Right.
How long did it stay flat? 1 year, 2 years?
1 year.
1 year. And at that point, you're out of options.
That's correct.
Okay, thank you, sir.
Thank you.
You made that point great, thank you. I certainly appreciate you and your wife coming. So, before we hear from the consumer advocate, we've heard from one other consumer, Randall Smith, who's, could not get off of work today. He has graciously provided us with a written statement. Joe Cragen of our office will come now and read that into the record. We'll have a copy of it as well. So if you'll remember to speak loudly, I've been prompted to speak up a little bit, so if you'll speak loud enough.
Only very rarely asked to speak up. Okay, as the director said, this is a letter from Mr. Randall Smith, who's from Lexington, South Carolina. He's in the law enforcement profession, and unfortunately, he intended to be here and could not be here today. So he did ask that this letter be read. It was dated November 5th, 2019, and it says, to Director Ray Farmer, South Carolina Department of Insurance. Thank you for notifying me of the hearing with Continental Casualty regarding more rate increases for long-term care policies. Unfortunately, I will not be able to attend as I still work after retirement at age 74 to help make ends meet, and part of that need is the rate increases imposed by this company on our long-term care insurance policies. Joe Cragen has my permission to read this statement in my absence. In the years leading up to my retirement age, the company encouraged a savings plan in preparation for retirement. Also encouraged as part of the overall plan was a long-term health care policy. I thought this was sound advice, and I began shopping around for a policy for both my wife and for myself. I did an in-depth study and comparison of several companies offering such insurance at the time and finally selected CNA. The policy had the benefits we felt we needed and was priced in line with the other companies. I selected the top tier policy as I felt it offered the protection we would need. We signed up for the policies in 2002, and things were fine until 2014. We were notified of an increase in our premiums. However, it didn't stop there. It seems we have had a premium increase almost every year since. Of course, with each increase, we were reminded that they were allowed to do so by language in the policy. When we were considering CNA, the agent we were working with assured us that increases in premiums were rare. And if I recall correctly, CNA had not had any increases in their history at the time, or if they had it, it was minimal. A small increase for minor adjustments might be expected, but my premiums have more than doubled, over 100%, which is very unreasonable. They went from $2,116 to $4,388 from 2014 to now. Now I understand that another 126% has been requested. Applying that to my current rate puts me at approaching $10,000 a year. This is insane. I was already to the point of having to give up my insurance in its current form, and now it looks like it will be a certainty. I simply cannot afford it and feel like we are in jeopardy. I'm sure I am not the only one, and I feel like we are simply being forced out. As these increases have come along, I've tried to find out what is going on with CNA. I've found multiple blogs on the internet with testimonies explaining that the customer service at CNA is awful. There are very few success stories. It seems they do everything they can to delay or refuse claims to the point of people giving up. This is probably another tactic, along with the premium increases, to encourage people to give up the policies and the money they have invested. Why keep putting money into this company if it is going to be impossible to get help when needed? I know the company's claims changes in the overall market has changed, causing them to lose money. Should long-term care customers be punished with premium increases because of their poor planning and forecasting? I think not. Do other major corporations get to go back and charge extra for old orders to cover their mistakes? I think not. Business models are built going forward to cover expenses and liabilities, and evidently that is something this company has failed to do over the years with the current and future products they are selling. I am very conservative and do not like big government, but it seems it might be a good idea for government to regulate this type of business to keep people from getting ripped off. If the language in the policy allows them to totally abuse customers with ad hoc premium increases, then the language should not be allowed at all. Thank goodness our state has the Department of Insurance that gives us some level of protection, or it would be worse than it is. I strongly encourage the department to deny these new increases and any future increases. The company needs to structure their current product base to cover their liabilities going forward. That would more than likely increase their prices and jeopardize sales, but it would be upfront with customers. Thank you for protecting us as much as you can. Signed, Randall Smith, Lexington, South Carolina.
Thank you, Joe, and certainly thank you, Mr. Smith, for those comments. Carrie and Becky, would y'all like to make a statement on behalf of Consumer Advocate?
Becky said she'll let me go. Good morning, everyone. I am Carrie Gruby-Liebarker, the Administrator and Consumer Advocate over at the South Carolina Department of Consumer Affairs. We appreciate the invitation and ability to comment during this time period on such an important topic. Our office is the State Consumer Protection Agency. We wear a sundry of different hats to make sure that we can accomplish our mission of protecting consumers from inequities in the marketplace. So we have the ability to intervene in certain insurance, rate-making processes, and other utilities. This is another one of those new roles. As well as we take consumer complaints. We refer a lot to the Department of Insurance. I think y'all are our number 2 as far as the agency we refer to those to, as well as we educate consumers. Financial literacy is a big part of our education effort, recognizing that making sure that consumers can participate actively in the credit marketplace is important, which this really speaks to this issue as well. So it's from those multiple hats and a sundry of various job responsibilities that we have at the department that I present our comments today. So when we heard about these incredibly high rate increases, it certainly caused us concerns. And I would put explanation points on all the comments made by Teresa with ARP as well as the consumers too. So I'll do my best to not repeat anything that's already been said, but I certainly agree with all those comments that we've already heard. But I think the number one issue that stepped out to us, other than the questions that we have on the rate making side of things, is what about the consumers who are on these fixed incomes? Consumers that have faithfully made their payments under these policies with the expectations that they would be able to reap the benefits of doing so. So I want to present a couple of statistics that we have culled from the Department on Aging, as South Carolina is one of those states that is becoming what I like to say the new Florida. You know, we have a lot, we certainly have an aging population. People keep moving here. And so we see the various healthcare services that are needed for that. We serve on the State Health Planning Committee, and long-term care is one of those topics that has been certainly at the forefront of those meetings. But when you look at our senior population, 11.5% of our seniors in South Carolina are living in poverty, according to data released by the Department on Aging. Over a third of those seniors live on Social Security alone, some with as little as $710 coming in per month. And then 51% of people aged 55 years and older have less than $50,000 saved for retirement. When you look at the amount of folks who are on fixed incomes, maybe those that have these policies, maybe those that don't, we certainly have the concern that if these increases were approved, that some of those consumers could be thrown into those categories. And when you look at medical and non-medical collections as well, the Consumer Financial Protection Bureau has done reports on this area that medical collection trade lines account for about 52% of all collection trade lines on consumer credit reports, because you get a medical incident that you may not have been prepared for, and then you don't have the funding to be able to cover it. And so the collection, the house payment will be made, a car payment will be made, but the medical collections, for a sundry of various reasons like price transparency, the complex insurance coverage, and cost sharing methods that you have in there are not something that consumers can predict, which is why they engage in contracts with long-term care insurance, you would hope. And even when you're looking at folks' credit reports, 50% of folks that have a medical trade line have no other kind of collection on their credit report. Healthcare is expensive, and so again, we're concerned about the potential impact that the increases will have on these consumers, their overall financial capabilities and stance, and then what will occur as they are 20 years later probably going to need these kinds of services that they were depending on, and them not being there. So that's essentially the comments that we have, and I'd be happy to answer any questions if there are any.
Okay, I really appreciate you coming. Those are great points. Thank you for what you do for our citizens of the state.
Thank you.
Okay, I don't think there are any other citizens that consumers would like to make any comments, but let me check. Seeing none. This morning we have with us Corey Peterson and John Monroe from CNA. We welcome you. We appreciate your coming. This is a tough subject for you as well as us, but we'd like for you now to come and make your presentation. This is Mr. Monroe.
All right. Well, thank you, Director, and thank you to everyone who has shown up today to talk about their personal stories and listen to our rate increase request and why we need it. I'm very empathetic to this issue. Years ago, my grandma had dementia, and she had it for a significant period of time. Before she passed away, I would say maybe 10, 15 years of it. She was in an assisted living facility to kind of look out for her safety and her well-being, as well as administer her medication. Completely drained her savings. She did not have long-term care insurance, and it was gone. So watching my parents go through it and witnessing it as well, it's important to me. This long-term care insurance product, the fact that it can help people with some of these expenses, it's really our number one priority to make sure we fulfill our policyholder obligations. And I'll get into this a little more with the presentation. So I'm John Monroe. I'm a fellow of the Society of Actuaries and a member of the American Academy of Actuaries. I lead the long-term care in-force management team, which deals with the rate increase side of the house, as well as how to come up with other options for consumers to help navigate these rate increases. So it's a legal disclaimer. Put it up there. So today I'm going to be talking about introduction to long-term care, and really kind of take a step back and say, what is long-term care cover? How is the insurance product structured? And hopefully provide a little more color around that. We'll talk about what has gone on in the industry. It's not just CNA, but also industry-wide, what has gone on with the experience to necessitate these rate increases. Why do we need them? How is it calculated? And then I'll get more into detail, sort of what Dave talked about for our preferred solution rate increase request and our older products rate increase request, or the RA16, RA17 programs. Then I'm going to talk about what else are we doing to help stabilize the block. So I think that's an important topic, because we're trying to do more other than just rate increase after rate increase to help make this a sustainable business. So introduction to long-term care. So long-term care is a variety of services that help people provide services to people who are unable to take care of themselves. Services can range from help with meal preparation to 24-hour monitored care. There's quite a variety. It's assistance and care for people with chronic disabilities to help them be as independent as possible. So what does it cover? It covers the cost of these long-term care services. It does not cover hospital or doctor bills. That's more into the health insurance umbrella. And then it does not replace lost income. That would be more disability insurance. So how can insureds be eligible to receive benefits? So policy terms differ, of course, but generally if an individual is eligible for benefits if they need assistance with 2 of 6 ADLs, or known as activities of daily living, or if they require supervision due to severe cognitive impairment such as Alzheimer's dementia. Then how can the benefits be used? Well, it's really 3 primary situses of care is what we call it. One is home health care, so help people age at home. And no one wants to go into a nursing home, so if there are services that can be provided to help people stay in their home, this would cover that. There's also assisted living facilities, and then of course nursing homes. So I think it'd be helpful to talk a bit about the long-term care insurance product. So it is known as a long duration product where, why that's important is that excess premium collected in early years are saved in the form of a reserve to pay for claims in the later years. So the product is structured such that there is a daily benefit. And for example, you would purchase a policy that has $150 per day to spend on services. When you purchase the policy, there's something called a lifetime maximum, so it may be unlimited benefit period, or maybe 5 years, for example. And there might be optional riders such as inflation protection, where benefits increase every year to help offset the general cost of services, and they're increasing over time. So I have a little exhibit here just to kind of describe a little bit of how the product is structured. So it's modeled out over an 80-year period, so a substantial period of time. When these products were originally priced, it was contemplating how do we think this will look over the life of the product. So that's their premium stream, that blue line, and it was anticipated that claims will start really low because people are purchasing it in their 50s or 60s, and then without much use for it. But in later years, the average age of claim upper block is 85 years old. That is where the claims really spike up, and in the early years where we put aside that premium that is over and top of the claims, we put it in the form of a reserve, invest it in that. We're basically collecting a pool of the premiums, and we're trying to grow that pool as much as possible with investment income such that when that claims curve is really high, we can use that pool to pay out the claims. So that was the design of the product. So I think before I get into need for rate increases, just high level, what has gone on in the industry? And there's a lot of different items that have happened, and it's not just with our company, but industry-wide for the over 100 companies that sold long-term care insurance. So we've talked a bit about lapse rates. This is the top left chart where we call it persistency, and that is a combination of mortality rates and lapse rates. So this is just illustrative, but the original expectation would have been that dark blue line. So when the product and the premium was developed originally, it was expecting some people would pay into the pool and not use the benefits. Similar to home insurance, you put money in the pool, not everyone is going to use it. And then over time, the pool would be big enough to pay out these claims. Well, due to people living longer, which in general is a good thing, but it puts pressure on the pricing of the product, and more people are sticking around, holding on to their policies for the 1%-ish lapse rate. Ultimately, that light blue line, over time, there's a larger pool of people that need to be supported by, that the reserves need to support. In addition to more people being around, claims are, more people are going on claim, and claims are lasting longer than expected. So that top right graph is showing that black line is supposed to be what we expected in terms of claim levels, and over time it keeps increasing year after year. So in addition to the persistency pressure, we also have the claim pressure. And then on top of that, low interest rates, right? The bottom left graph is showing the 10-year treasury, and how over time it just keeps dropping and dropping and dropping. And if these products were priced in the 80s where 10-year treasury is at 9%, and then now it's at, right now, it's 1.8%. It's just additional pressure that it's putting on this product. If we have that big pool of money that we're collecting to pay out, we can't grow it fast enough to cover the claims. So There was a comment made about the, just lower on this topic, about investment rates and how we are, in our filing, we're using current investment rates. Well, that interest rate used in our filing is actually a statutory maximum valuation rate, and is defined by regulations to use that statutory prescribed rate. What we have done in the past is we've looked at that interest rate and compared it to what have we actually made on our assets in the past. Did we make substantially more or less than that amount? Our after-tax investment rate has actually been about the amount that's used in our filing. Partially because we invest in a very conservative long-term portfolio. We don't want to take on a lot of investment risk if our goal is to cover policyholder obligations in the future. So very high quality bonds. We're not investing in stocks. We're investing in highly long duration, 30-year bonds to make sure that we keep growing that pool in a conservative way to make sure we can pay it out in the future. So really the adverse experience, this combination of experience has done a number of things. One is it's increased risk profiles of long-term care insurance blocks across the industry, putting pressure on the company in general. Lower returns on investment assets used to grow the reserves, hit on that. And negative financial results, which it has contributed to some insurer insolvencies, a big one being Penn Treaty. The industry is still trying to, industry and regulators are trying to manage that issue right now. So I think the next natural question is need for rate increases. Why? Why do we need them, and how is it calculated? So this graph is what I just showed. Which I'm calling the original pricing example. This was the expectation. And in those early years, premium exceeds claims, so we're putting it aside in the form of reserve to help pay for future claims. Well, as I talked about this adverse experience, that claims curve actually bent towards the left. So claims are coming in higher, there's more people around to have to pay claims, so that dotted red line, that is how our claims have developed. So how do we cover that? Well, that's really where the rate increases are needed. So what happens is that that line of blue has to bump up a bit, and so that additional premium dollars needs to get thrown into the pool to help grow it to pay for our claims. So a few points before I move on is the long-term care product performance is evaluated over the lifetime of the product. We don't look at last year and say, oh, last year was bad, let's ask for more rate. We look at the entire 80-year period, historicals, and what our revised projections are. And due to the long-term nature of long-term care insurance, the insurance buzzword was guaranteed renewable, but insurance companies do have the right to increase premiums. And determining the need for a rate increase is a mathematical calculation. It combines historical experience and future premium and claim projections, and excludes expenses in the analysis. And long-term care rate increases must be filed and approved by the state. I think we all know that at this point. So that's more, first few slides are kind of industry, broad-based, what has been going on high level. Now I'll dive a little bit more into our specific rate increases. So first, I know there's been some feedback, and I appreciate the comments and feedback from consumers on this. So I know one of the comments was about how we're trying to avoid paying claims, right? So just in general, I pulled a few numbers on this. So currently, right now, we have 19,000 open claims, which we're paying dollars on. 750 new claims are added per month. These are claims that we are opening and paying real dollars on. As of the end of September, we've paid $700 million out in claims to people on this with this product. So this is a real issue. We're paying out real dollars, and ultimately, it's my job to make sure that we have enough for that pool to pay and honor our policyholder obligations. So Preferred Solution. Preferred Solution is our largest individual product generation with about 70,000 lives nationwide, over $4 billion in that big pool of reserves collected to date. 156 million in annual premium, and we almost have 4,000. Of that 19,000 claims, we have about 4,000 of them are due to this preferred solution product. In South Carolina, I thought it would split it out a little bit in terms of the numbers, just to give an appreciation for the size of South Carolina versus the rest of the nation. We have about 670 open policy counts for South Carolina on this whole product. The rate increase is only on policyholders with inflation, so this is a slightly larger number. We collect about $1.5 million annual premium, and just for South Carolina, we have $36 million of reserves put aside to help pay for current and future claims. So this product was sold between 1998 and 2003, and the nationwide program applies to policies with inflation riders only, and that is where that daily benefit I talked about grows by 5% per year. Actual inflation has been far lower than that, especially recently. So that 5%, there's a bit of a gap between what people could spend with their policy versus what the cost of services are. And that's part of why we structured the program this way. So anybody with preferred solution policy who does not have that automatic inflation will not be receiving a rate increase. So this is what we call a follow-up rate increase. The first rate increase in this program was in 2017 with a 20% increase. We initially asked for 146.5% rate increase. Obviously very, very large number, but that number was calculated such that we wanted to calculate a 100% lifetime loss ratio. So that's insurance speak, but essentially what we're trying to do is we're just trying to collect enough premium to pay the claims, nothing more. There's no expense provision, no profit provision. It's just we're just trying to break even on this. So as we received the 20% increase in 2017, the remaining amount is 126, which is the number that we're seeing today. So I know Teresa talked about this, looking for additional options for insureds, and that's honestly that is part of our team, is to try and find out. We listen to regulators, we listen to consumers. I see all the complaints that come in, and is there anything we can learn from the feedback from policyholders, regulators, other carriers, that we can make this a little easier if that's even possible. So one of the options is that inflation rider. So given there's been a spread between how quickly benefits have been growing and the actual cost of care, if you choose to forego future inflation, and because what you have today may be enough for your situation, you can keep the amount that you've inflated to. So if you had $150 a day, it's inflated to $300 a day. You can keep that $300, forego future inflation. You completely avoid the 126% rate increase, and quite often your premium will drop from current levels by about 30 to 40%. So it's not just a avoid the rate increase, it's a step down in the premium. So nationwide, it's been a popular option for insureds. About 40% of people nationwide have been electing this option. Another option that was discussed is this non-forfeiture option, which is, again, insurance speak, but what that means is that we look at the amount of money that you've paid in to date over the life of your policy. For example, if it's $50,000, a standard non-forfeiture offering is if you can just drop your policy, not pay any more future premium, and we will hold the $50,000 aside in case you go into long-term care services, and it'll distribute. However, we've heard some feedback from regulators and consumers saying, well, I could have just invested the $50,000 and had a larger pool of money, so I'm not very excited about $50,000. So we took that feedback and said, you know what, we'll offer a 150% of your lifetime premium. So instead of the $50,000, we'll offer a $75,000 pool to help pay for services. So it's trying to provide a little bit of a provision for that after hearing some of the commentary. There's other options such as you can reduce your lifetime maximum, lower the daily benefit, extending elimination period, which is the deductible. You can increase your deductible to help offset some of it. And we're trying to make it easier for consumers as well. Through the notification letters, some comments about how you get this document, you just don't understand it. We're listening to that feedback. We're trying to make our letters simpler and more of a common language, and it can be hard to do sometimes, but after feedback from consumers, we are trying to make it easier. We're also trying to provide quotes directly in our notification letters, just to say, this is what you're paying now. If you choose one of these options, this is how much you would pay, and hopefully make it easier, a little more transparent with consumers, so you don't have to call a 1-800 number and get a quote 3 weeks later. Hopefully that just makes it a little bit easier. So that's our preferred solution increase. The older products one, or the RA17, consists of 3 different product portfolios. Covers about 56,000 lives. We have about $4 billion in reserves, $110 million in annual premium, and almost 7,000 open claims. So the preferred solution, we have 3,800 claims, about 7,000 open claims on this one. South Carolina, there's about 300 insureds and about $16 million in reserves put aside for now for people currently on claim or for future claims. These products were sold a little prior to the preferred solution, starting in '93, and how this strategy or program was structured such that we wanted to vary the rate increase by product portfolio to be sensitive to the age of the insureds receiving it. So what that means is that the older the product, the lower the rate increase requested. So from a mathematical perspective, if you just ran the numbers of what could be actuarially justified is the term, it could be 600, 700, 800% rate increases. Obviously, it's a very large number, and so we're asking for an amount less than that, just because we believe that is an unreasonable request. So the Premier Classic product requested 25%, Preferred Advantage was 35%, and the TQ product was 40%. We received an increase for 20%. So what is remaining on this is 5% for the Premier Classic, 15% Preferred Advantage, and 20% for the TQ product. So similar to the Preferred Solution product, we want to offer that 150% non-forfeiture benefit just as an alternative, in addition to the reducing lifetime maximum, reduce the daily benefit, remove optional riders such as inflation, and again, we're trying to integrate some of that those communication improvements in our notification letter to try and make it more obvious as to what we're actually saying, why we need the rate increase, but try to provide quotes for insureds to at least help make their decision when they talk with their financial advisor or family members on what decision to make. So I wanted to talk a little bit about this. What else are we doing to try and stabilize the block? And I think this is something that more and more insureds need to be focusing on, such that it's not just rate increase after rate increase. What else can we do? So we're working with wellness and claim initiatives designed to provide value to our insureds and have the potential to reduce claim risk over time. And this could reduce the likelihood and the amount of future rate increases. So no one wants to go into a nursing home, so I think there's incentives aligned between the insurance company and consumers. If they need it, obviously the policy's there, but is there something we can do to help people age in their home, or utilize home health care instead, or provide some of these preventative medicine options to insureds? So from a wellness initiative, that is before people are on claim. So there's a few items here that we're focusing on. One is fall prevention, that we will perform an in-home assessment with personalized action plan, wellness kit, including a health coach and follow-ups to kind of say how can we avoid some of those slip and fall situations where it would be an acute problem, broken hips or other ailments like that. We also have an emergency response device, which could be in-home sensors or wearable devices to help detect falls and or if there's diminished capacity, and then we can intervene and help provide that medical intervention. We also have medication management, which would be app-based, but it's something to provide reminders to take medication at the right time, make sure that you adhere to your medication plans, which would either limit or delay the requirement for long-term care insurance or long-term care. And then there's the cognitive assessment and training. So it's another app-based software that would help. It's a bit of a brain training tool which could help address the risk of cognitive decline and social isolation that can influence the need for utilizing long-term care. So that's all the pre-claim side of things, but there's also on-claim initiatives that we're working on. One is what we call fraud, waste, and abuse. So we've instituted more robust oversight to increase the identification of suspicious claims for investigation. And the focus of this is to not pay claims on people. It's not about that. It's about making sure we're paying claims on people who actually need it, instead of people trying to game the system. Because that ultimately that gets passed on via rate increases. Electronic visit verification is another one. So that is one where we utilize technology to improve controls around independent caregivers to reduce overbilling. So that could be a situation where someone is, an independent caregiver is filling out their time card, they leave maybe 15 minutes early and say they worked the whole hour. Ultimately, we'd be paying for the full hour, reducing the ultimate amount of money left for the insured. So it's trying to institute some controls around that to make sure they do stay for that whole hour, or they will only bill for 3/4 of an hour, which would preserve some of the benefits for the insured. And then provider management. So that's another one where we are trying to make policyholders aware at point of claim about independent or virtual agencies. It'd be similar to like an Uber, but for home health care providers, because ultimately have lower overhead than an official home health care agency, which might be charging a significant premium on top of their actual cost of services, which just comes out of the remaining benefits for the insured. So if there's a way to get the same amount of services or care from a virtual agency, it preserves the insured's benefits, and we have to pay less on them. So there are incentives, there's an alignment of incentives between insureds and us, and we're trying to utilize these services to help our consumers. So in summary, the long-term care insurance industry has faced a number of challenges due to increasing adverse claim experience. Due to the pre-funding nature of long-term care insurance, additional premium dollars are required to ensure there's enough money in that pool to pay for future claims. And as rate increases are difficult for insureds, we are trying to provide options in lieu of paying the rate increase, and constantly trying to think of what else could we do to provide more options to insureds. We also try to explore programs that could help insureds stay healthy and minimize fraud and abuse, which could help insureds conserve benefits, lower the overall risk of long-term care insurance to CNA, and possibly decrease the likelihood or size of future rate increases. So I know I heard a lot today from everybody, and I do appreciate the feedback from everyone. So I thank everyone who attended, and also thank you to Director Farmer for the opportunity to speak today.
Well, thank you, Mr. Monroe, for coming. That was a great presentation, but I've got a couple of questions, and then Consumer Advocate may have some questions as well. You heard from our two citizens that are here today, Mr. Middleton, Mr. Drinkard. They both have taken some of the options that you listed. Non-forfeiture for Mr. Middleton, dropping the inflation guard for Mr. Drinkard. How long have y'all offered those options?
So the ability to drop any of your benefit features has always been a provision of the contract. I just feel it has not been advertised, or the transparency hasn't been there. So now with these rate increases, we're trying to provide that transparency to insurers to say, these are your options that you have. An agent may not have been transparent about this is how much each one of these riders cost in terms of premium. So we're trying to show people this is, if you were to peel off these benefits, this is how much premium you would save.
Okay, so Mr. Middleton, I think had the, took the non-forfeiture provision. You may or may not know the answer to this question, but was he able to get the 150% of the amount, or was it, is that something fairly new?
The 150 is fairly new. It is, it was only brought into existence a year ago, and all future rate increase filings have that, on our individual block, have that offering.
Is that fair to him now?
You have to assess the situation, you know,
Right.
whenever you get the rate
I
increase.
get that.
Right.
And so, Mr. Drinker, dropped the inflation provision, inflation guard.
Right.
So you also indicated that those, and I don't know if I'm confusing two blocks here, but you said those not in preferred solutions will not get a rate increase. Well, he had the opportunity to get a rate increase. How does that, if he dropped the inflation guard, why is he getting a rate increase?
So if
I
you,
think I saw him asking that question while you were saying that, and I wanted to verbalize that for him.
sure, yeah, so if he has a preferred solution policy, there would not be a rate increase on that. So
Okay.
what is the?
But so maybe we, after the hearing, you talk to Mr.
Yeah, of
Drinker,
course.
you talk to Mr. Milton, and
Yes.
see if there's anything else that we need to be chatting about.
Absolutely.
So we won't get in all that. So we've granted rate increases, some, obviously you're asking for a lot more. There's a big debate going on at the national level of the National Association of Insurance Commissioners. If I'm granting these rate increases, am I subsidizing your policyholders in other states?
That's a fantastic question, and it's a question we get a lot from other states. We structure our rate increase such that mathematically we assume the whole nation is granted what your state has granted. So mathematically speaking, it would ensure that if California is not granting a rate increase, insureds in South Carolina are not paying for that.
Okay. So go back to your R16 block. Would the company have requested the rate increases on that block earlier if there was no rate guarantee?
So there's a few components there. One is about the credibility, right? If 5 years in we don't have the credibility, we don't want to make a knee-jerk reaction and adjust premiums if we don't need to, or if it would, the coin flip would come back the other way. But it's hard to say. I think there would have been indications from persistency misses on the lapse or on mortality that might have said maybe things are trending poorly, but ultimately you have to wait till enough people are going on claim. And if people are purchasing it in their 50s or 60s, it's going to take a while until they reach that claim age to get 100% credibility.
But should policyholders have to fund the losses from that guarantee?
So ultimately, we're just trying to collect enough premium to
Right.
pay all the claims.
Okay. I have a feeling the consumer advocate folks will have a question or two.
So one of my questions, thank you for your presentation, because like I said, we hadn't had an opportunity to review everything prior to coming today, but one of my questions is, you provided a lot of nationwide data and why the industry is needing to make rate increase requests. As we heard earlier, your request is substantially larger and would make it go above what the national averages. I believe the comment was 10% increase would put you in line with the national average. So I guess part one of my question is, why such a large increase to get above that national average? And then, bless you. And then number two, you gave a lot of comments about, I guess, initiatives to stabilize the block on the consumer end, but on the business end, is there anything other than requesting rate increases that you all are doing? You mentioned having very conservative investments. Are you looking at your investment portfolio to see if there are changes that need to be made there? And then otherwise, how can we also trust that if for some reason, this rate increase, which I don't know would be, what was granted, how do we know that your calculations have been adjusted to correct the errors that have been made in the past? I guess that's a three-part question, which
Right.
they link together in my mind.
Right, of course. So going, what was the first one?
The first one was, why is your request so much
Why is
higher
it?
than
Yeah.
what we
So
bring into the nationwide
Our,
average?
the nationwide average is a moving target. For states that have not granted the full requested increase, we continue to file and work with the state to achieve those rate increases. So the nationwide average is continually going up. And it's the same story in other states where they are seeing a similar sized request. So it is, South Carolina is not being excluded from this or isolated from this rate increase initiative. We're having these conversations in every state. So the nationwide average is continuing to move upwards, and it will continue to move upwards. It's just a matter of when. In terms of I think the other question was about the wellness initiatives. So what else are we trying to do? So obviously we run a very tight ship. We don't want to spend more money than we need to within our division. So we're really trying to manage and minimize our expenses from the divisional level. In addition to this, which would help the company out in terms of reducing the risk of the block, it also helps insurance preserve benefits. And we're also trying to come up with other options instead of paying the rate increase, right? Instead of just increasing premium, is there a way to modify the benefits such that it's satisfactory to the consumer and they do not have to pay these types of rate increases? So we're always thinking about what is the industry doing, what other options are there, can we get creative, what else can we do? So that's why we're always reading the complaint letters that come in, listening to the feedback, and trying to keep our ear to the ground of what else is the industry doing and what else do regulators want to see. So it's really important. And I'm sorry, what was the?
Their question was, how can we trust that
How can we
if
trust,
the
yeah.
rate increase were granted, that we wouldn't come back later with the errors?
Right. So if experience develops as we expect on this rate increase indication, we wouldn't expect that we would need to come back. We are monitoring this every year. We have a team dedicated to the modeling and projections and monitoring experience, where that is their full job, is just to say, how is experience coming in, how can we refine our assumptions, refine our projections to make sure that hopefully we get it right.
Okay, so I've got one other question. You mentioned the fact that at some point there were 100 companies selling
Yes.
long-term care insurance, and now numbers I see now, there's less than 10 and probably 7, if that many. Obviously, the industry has lost money on this product, and some companies no longer sell it.
Right.
Part of my job is solvency concerns.
Yes.
You mentioned Tree. That's a long-term care company that over the years became insolvent, and now the rest of the insurance industry is picking up the tab for that. And trust me, we look at rate increases. We want to make sure companies are there to pay claims like they're supposed to. Mr. Monroe, whether I grant this rate increase or not, CNA's not going out of business. I'm measuring, balancing everything. Solvency's one of them. You no longer sell the product, probably wise decision. But how do I justify all that?
No, it's a fair question. The long-term care block at CNA is primarily a property and casualty insurance company, but this block of long-term care has about 40% of the entire company's reserve levels.
Yeah.
So it's significant, and if you look at the market capitalization of our company is about $12, $13 billion. That is the size of our reserves, right? So there's still a significant amount of risk that if this block is not managed to be self-sustaining, it could really damage the company.
Okay. All right. Carrie, do y'all have another question or two?
Just a couple.
This is Becky Dover.
The rate increase that was approved? I think you said back in 2017 or 2018,
There were two of them, so the older product was
Um,
18, the preferred solution was 17.
preferred solution.
Okay.
So how many people chose one of the options in lieu of paying the rate increase then?
That's a good question. So, I know I said nationwide, the election rate of that inflation drop, nationwide was about 40%. In South Carolina, it was 20%. So about the amount of the rate increase is the number of people that elected that option. And in terms of the experience on the increased non-forfeiture, we have yet to offer that in South Carolina. This 150% this would be the first rate increase, first filing that includes this offer for South Carolina. But in other states that we've been tracking, anywhere between 5 and, actually it's about between 7 and 12% of people will elect that option, then the remainder pay the rate increase.
Between 7 and 12% chose the option in lieu of the rate increase?
The 150, this specific option. So about
Okay.
20% of people chose one.
Okay.
Number two, what we've seen nationwide is between 7 and 12, so we call it 10%. And the remainder paid the rate increase.
And that was for the same amount of a rate increase request? And was the rate increase request for 80% or was it similar to 126%?
So in other states, the rate request would have been similar numbers. Where the increase in forfeiture, where we're getting our data, was actually based off an older products filing in other states, and that's where we saw the 7 to 12%. So the asks, the requests were a little lower, and the amount that was approved was a little lower than the preferred solution. But now we're seeing approvals across the country that are including 150% on preferred solution. So it takes a long time for the approval process and then for insureds to get their letters, notification of the increase, and then to collect the data and analyze it. So we're always looking at that though, because those are important numbers to us and helps inform what else do the consumers want to see.
Okay. And I guess I'm trying to figure out what would be a good percentage there to make sure that, I guess it seemed more stabilized. So if 25% of people chose one of those 3 options instead of the rate increase, does that stabilize it? I mean, or would you likely need another rate increase?
So it's not like one option is better than the other to us. One is people can pay the rate increase and maintain their benefits as they purchased it, or if they feel like their benefits are sufficient under a reduced benefit scenario. Ultimately, they affect different sides of that loss ratio calculation, right? If our 100% loss ratio calculation is total claims divided by total premium, if the premium is increasing, that is one component of the calculation. Another one are the total claims, where they come down a little bit as a result of the reduced benefits. That's the other side of the calculation. So it's not necessarily one is more advantageous to us than another. There's just more options.
And I think that's all I have.
Okay. Thank you for coming. I think that's all of the people that signed up to speak with us. Mr. Peterson, you have some remarks to make? Ms. Monroe, thank you for your presentation. Thank you for listening to us. I would encourage you to talk to Mr. Drinker and Mr. Middleton and see if there's anything else you can do to help our policyholders, our citizens in this state. So our next step is we'll continue to review the rate filing. We'll review transcript of this hearing, and then we'll make our decision. So before the legislature granted us this authority to hold a hearing, the process would have been, we get a rate filing, we make a decision, then if the company disagrees with it, they appeal it up through our administrative process, hearing process. At that point, consumers really have no say in that process. So this is the opportunity for our consumers to be heard. We appreciate you coming, we appreciate you listening to our consumers. Like I said, this was our first hearing. We thank you for being first out of the box, but you will not be the last, trust me. So with nothing else, I appreciate everybody's attendance today, and that concludes our hearing.